All right, let's talk about something. What if I told you that one of the oldest rules in investing, buy low, sell high, might actually be costing you a ton of money? Today, we're going to pull back the curtain on a really common pitfall called the value trap. And more importantly, I'm going to show you how to spot it before it's too late.
So be honest, have you ever been there? You're staring at a stock in your portfolio, it's just bleeding red day after day, and you're frozen. You can't bring yourself to sell, just hoping it'll turn around. Well, that feeling, that hesitation to just cut your losses, it's not just you. It has a name, and it is a powerful force that messes with almost every single investor out there.
It's called loss aversion. And here's how it works. Think about finding a $20 bill on the street. Feels pretty good, right? Now think about losing a $20 bill. Ugh, it feels awful. Well, psychologists have figured out that the pain of losing is about twice as intense as the pleasure of winning. And that bias is what makes us cling to those losing stocks. It's not really about logic. It's about trying to avoid that gut punch feeling of admitting we got it wrong. And this isn't just some interesting little mind game. It has huge, real-world consequences for your wallet. I mean, look at this. Research shows that over a 30-year period, the average investor's return was nearly half of what a simple benchmark portfolio made. We're talking about a potential difference of hundreds of thousands of dollars. Why? A lot of it comes down to emotional decisions, like holding on to those losers for way, way too long. The whole problem usually kicks off with that classic piece of advice: buy stocks when they're cheap. For decades, this wasn't just folk wisdom. It was actually backed up by some pretty serious Nobel Prize-winning research that seemed to prove that hunting for bargains was the absolute smartest thing you could do. Yeah, this research basically found that so-called value stocks, companies that looked cheap on paper based on things like a low price-to-book ratio, they consistently beat the more expensive growth stocks over the long haul. This idea became the bedrock of value investing for an entire generation. But here's the thing. The world has changed. A lot of today's biggest winners, think about companies like Google or Microsoft, they don't have a ton of physical assets. So that old way of measuring book value doesn't really capture what they're truly worth. And because of that, the whole buy cheap strategy just isn't working like it used to. In fact, its effectiveness has plunged by 40% since its peak. And this chart right here, wow, it just lays it all out. It's pretty shocking, actually. In recent years, the bucket of stocks that are technically the cheapest have actually delivered the worst returns. And get this, with the highest risk. This is the value trap in action, right here. What looks like a bargain is often just a really bad business in disguise. So let's define it. A value trap is a stock that's cheap for a reason. The business itself is in trouble, maybe its sales are falling, it's getting crushed by competitors, or the management team just can't get its act together. It's like an investment mirage in the desert. It promises a beautiful recovery that just never, ever arrives. So we need to completely reframe the question we're asking. We need to stop asking, is this stock cheap? And start asking, is this a high-quality business that happens to be trading at a reasonable price? That little shift in perspective, it's everything. It is the key to dodging those value traps and actually finding the real long-term winners. And we can break this down into a really simple but super powerful two-step check, okay? First, how good is this company at actually generating cold hard cash? And second, once they have that cash, how good are they at reinvesting it to grow the business even more? Now, our first metric sounds a little technical, operating cash flow to EBITDA. But don't let the jargon scare you off. All this really tells us is how much of a company's profit on paper is actually turning into real cash in the bank. You see, a healthy, high-quality business is a machine that consistently turns its profits into actual cash. Let me show you what I mean. Here we've got a tale of two very different companies. On the left, Alcoa. Its cash flow is all over the place, and look at its stock. It's basically gone nowhere for a decade. Then you look at Microsoft. It's an absolute cash-generating machine, and its stock has been a massive winner. The lesson here is so clear. Consistent cash flow is king. And the data just backs this up completely. If we go back to that original group of cheap stocks, the ones that performed so poorly, and we do just one thing, remove the companies with the weakest cash flow, look what happens. The returns jump a lot. This one simple filter helps us sidestep so many of the worst value traps out there. Okay, on to step 2. This is all about what happens after the company makes the cash. Our second metric is return on invested capital, or ROIC. Honestly, you can think of this as a report card for the management team. It tells us how good they are at taking the company's money and turning it into even more money. And here's another perfect example of this in action. Land's End has a really spotty ROIC, and its stock has been a total dud. Now compare that to MCore Group. They have a fantastic track record of reinvesting their capital really well, and what do you know? Their stock has been a consistent winner. It just goes to show you, smart reinvestment is absolutely crucial for long-term success. So when we put these two ideas together, strong cash flow and smart reinvestment, the results are just, they're powerful. By starting with those cheap stocks, but then filtering out all the low quality businesses, we end up with higher returns and less risk. We've successfully weeded out the traps and found the real deals. Okay, so this all sounds great in theory, but the big question is, how do you actually use this stuff with your own investments? Well, let's make it super practical. Here's a simple checklist you can use. Okay, here's your new game plan. Number 1, look beyond those simple "is it cheap" metrics. Number 2, make the quality of the business your absolute top priority. 3, dig in and check for a history of strong, consistent cash flow. 4, grade the management team's skill by looking at their ROIC. And finally, number 5, focus on where the company is going, not just where it's been. So the next time you're thinking about buying a stock, I want you to ask yourself this one question. Are you hunting for a bargain, or are you hunting for quality? Because that answer, well, it could be the difference between a portfolio that's just stuck in the mud and one that's truly built to last.